So I will start off by talking about a few fund details before moving on to some of the position changes that have driven performance for the fund. We do have 3 fund shares for the Total Return Bond Fund. They're listed here with their associated tickers, the minimum investment sizes, and also the expense ratios. Any reference I make to a fund or the strategies for this webcast will be a reference to any of these available share classes. So if you're invested in any of these share classes, these comments will apply across the board. Quite a few numbers on this page, but I'll draw your attention to the third column from the left. This is the YTD or year-to-date column, and then also to the far right, the since inception column. As of May 31st, 2025, all 3 share classes of the Total Return Bond Fund are outperforming the Bloomberg Aggregate Index. This is for the year-to-date and also since inception periods. This is done through active management. The team's been focused on delivering attractive risk-adjusted returns through all market environments. And certainly those time periods have really kind of tested certain market environments. Just 18 months ago, the commercial real estate market was battling some tumultuous times. This year, in 2025, things have turned around. We see a handful of marquee commercial real estate transactions. Financing availability in the segment of the market has returned again and is active. So that's definitely been beneficial. On the slide here, we're looking at valuation data by subsector of the commercial real estate market. And almost everything has rebounded since the trough of 2023. The beige line may be an outlier here. It's actually not doing that well. And this represents the industrial sector. And that is showing some weakness. An example of an industrial commercial real estate asset could be a warehouse or a logistics center. And due to overbuild post-COVID, we are seeing some additional vacancies and some softer leases here. And that's certainly impacting valuations towards, putting some challenging valuations there. Now, most recently, we have seen some improvement in absorption rates. And that's especially encouraging because this area, it's also impacted by the proposed tariffs. So that is some positive news, and we may be seeing some turnaround there. But that's why the industrial complex is having some headwinds. Now, our investments in CMBS, they've done very well. They've added to the fund's outperformance. And I'll speak a little bit more detail about what we are doing in those portfolios in just a minute here. So here's a visual of the relative value between CMBS or commercial mortgage-backed securities and corporate bonds. The red shaded area depicts periods where corporate bonds offer better relative value than CMBS. And then the blue, it indicates that an investor is getting better compensation or spread for CMBS versus their corporate counterparts. We have 3 charts here. The top one is comparing AAA CMBS, so the highest quality, versus investment-grade corporate bonds. And that index is a single A index. And here, what it's telling us is that an investor is getting more spread for AAA CMBS than for a single A-rated corporate. The middle chart showing single A CMBS versus triple B corporates. And then the last chart on the bottom there, triple B CMBS versus high yield bond index, which is a below investment grade index. In all 3 charts, CMBS is showing that it is attractive on a relative basis versus corporate bonds. We have liked CMBS despite all of the noise in that market, and the sector has performed very well for the fund. This is something we've been tracking for some time. After a long payment moratorium, federally funded student loans finally resumed payment again. This is in October of last year. And we are starting to see the effects of that in Q1 of 2025. And we're seeing delinquencies rise sharply. Servicers, they're more diligent in attempting to collect any late payments. And we do expect this to drive delinquencies higher in the months to come. I didn't include any other consumer charts for this webcast, but I'll say that delinquencies are rising in all borrower cohorts. 12% of the U.S. population have student loans. So that just creates another headwind for the consumer. We've taken a more defensive approach to consumer assets. We've reduced some exposure. And then with the positions we continue to hold, migration into senior tranches or more protected tranches there that can withstand even the most draconian stress scenarios. is what we have been doing. Another area, we've taken a more defensive stance. Here, we're looking at CLO spread differentials. The blue line is the difference between AAA and AA CLO spreads. And then the gray line shows the spread difference between AAA and single A CLOs. The trend's the same on both of these kind of lines here. We're seeing compression in both lines. And that's telling us that investors are not getting compensated as much as they historically have for lower rated challenges within the CLO market. We've reduced some CLO exposure within the strategy, but also migrated to the senior most tranches. And the focus is really on quality. Given the premium is so thin for taking on additional risk in this space, it does make sense to us that being in the safest AAA tranche here for the CLO market is prudent. A couple of slides on performance here. Here we're looking at year-to-date performance of the total return bond fund, broken out by the separate components. And these are the blue bars on the left. And then we're comparing that to a couple of indices shown here in the gray shaded area, the yellow and the dark blue, yellow being the Bloomberg US Aggregate Bond Index, and then the dark blue being the Corporate High Yield Index. A couple of takeaways from this chart. Firstly, DBLTX as a whole has outperformed the Bloomberg Ag Index, which is its benchmark. But our largest exposure, agency mortgage-backed securities and treasuries, these are government-guaranteed assets. They've outperformed the index by over 45 basis points year to date. So very strong performance by, well-protected asset. Secondly, what I would want to kind of just highlight here is the credit component of DBLTX. And this includes non-agency mortgage-backed securities, CMBS, CLOs, and then asset-backed securities. They've done very well despite the volatility in the markets. During the first 5 months of this year, most of these components have outperformed the high yield corporate bond index while investing in very high quality investments. Active management and discipline is from the team is really kind of what has driven fund performance over the years. Here we're looking at the makeup of the CMBS segment of the total return bond fund and comparing the positioning from June of 2024, so just about a year ago, and this is the blue bar, to the latest month end, May 2025, and that's represented by the gray bar. The CMBS component of the fund has outperformed the high yield index, the high yield corporate index, I should say, year to date. And this is not due to taking on more risk. As a matter of fact, it's exactly the opposite. We have been actively increasing the AAA exposure here, and it's gone from about mid 30% in the middle of 2024 to almost 55% today. So a pretty dramatic increase in AAAs. The below investment grade portion of this portion of the fund was also reduced during that period. So we've been moving up in quality and still outperforming a heavy punching high yield corporate bond index on the CMBS side. Similar situation within asset-backed markets. Here we increased single A exposure in the portfolio and reduced below investment grade assets in the asset-backed security space during the same time frame. The ABS segment of the total return bond fund had the strongest return year to date. It's outperformed the high yield bond index, also with the same theme, while improving the overall quality of the assets that we're investing in there. And then finally, the largest segment of the portfolio, agency mortgage-backed securities. We are active investors in both CMOs, and these are collateralized mortgage obligations, and pass-throughs, but do migrate between the two depending on our views of these spaces. Here we see a meaningful increase in pass-throughs from mid-June 2024 till now, and a reduction in CMOs. I do want to remind you that technically we had an overweight in CMOs in late 2023, and this is due to the regional bank debacle. CMOs, they offered really a meaningful pickup in value versus pass-throughs, but since then we have harvested those gains and reverse positioning into this year. So right now, spreads between pass-throughs and CMOs are relatively tight, but pass-throughs do offer excellent liquidity. So it did make sense for us to make this change. I don't think you say moving from one government guaranteed asset to another, you can't make the argument that you're moving up in quality, but certainly this move has improved liquidity profile for the fund. And we do think that's additive to the investors and still has given us the ability to outperform. Duration. So here we're looking at duration of the fund. the fund is positioned just slightly short versus that of the index. And this served us quite well, given the increased volatility that we've seen in 2025. Here, the blue line depicts the duration of the fund over time, and we're comparing versus the 10-year Treasury yield, and that's in red. Much of our duration is being accessed through mortgage-backed securities, the government-guaranteed mortgage-backed securities, but we're also using some Treasury futures to help us fine-tune our duration positioning. Here is the key rate durations. We do have a slight steeper position in the fund. And looking at key rate durations, the blue bars represent the key rates for the fund, and the red shows where the key rates are for the index. We have an overweight at the 2-year part of the curve and then underweight at the 30. So that pretty much shows you how we are positioned for a steepener within the total return bond fund. A few statistics on the fund duration. As I mentioned, slightly shorter versus the index, coming at 5.71 years, and then the index just above 6 years. And then yield to maturity almost 100 basis points better, with a focus on high quality assets, also with a shorter duration, so lower interest rate volatility. We're still picking up a yield advantage, so that certainly has been beneficial as well, and helped drive some of the outperformance. Here we're looking at positioning of the portfolio. 58% of the portfolio is in government guaranteed assets and cash. I did speak about this earlier. We are leaning more heavily into government guaranteed pass-throughs at this point in time. And then on the credit side, we are in secured high quality credit assets. These are the CLOs, CMBS, RMBS, and asset-backed securities make up the exposure and do offer really attractive yield with a high rating at that. And as we migrate up in quality in our credit assets, you can see here the red bars. This represents serious delinquencies of each of the sectors in credit, and it's dwarfed by the sum of the gray and blue bars, which are the credit enhancement. And what credit enhancement is the ability for our bonds to take collateral loss before seeing even a dollar principal impairment. So investors should comfort in this high quality yet really well protected, even if things get much worse in the economy. All right, that concludes the portfolio portion. Thank you very much.